In the late hours of December 3rd, 2025, as financial screens across Mumbai's business district flickered and traders recalibrated their positions, a subtle sense of unease threaded through the air. It wasn't panic. Markets had weathered worse, but a quiet recognition that the Indian rupee had crossed a line that had long seemed distant. The currency had slipped past 90 to the US dollar for the first time, settling at 90.19 after touching an intraday low of 90.29. What seemed like a minor intraday fluctuation, barely a 0.4% fall, actually marked the latest step in an 8-month descent that had chipped away over 5% of the rupee's value since the start of the year. To understand how India reached this point requires retracing more than a decade of economic shifts, policy experiments, global shocks, and structural fragilities that have gradually weakened the currency's defenses. Back in 2014, when the rupee hovered close to 60 to the dollar, expectations surrounding a new government were high. Yet by late 2025, the currency had lost roughly 45% of its value during the period of the Modi administration, considerably sharper than the approximately 30% drop experienced in the previous decade under the UPA government. This sustained erosion was not a sudden collapse, but the culmination of several persistent pressures: widening trade imbalances, chronic reliance on energy imports, and inflation rates that consistently outpaced those of the United States. With India's consumer inflation averaging near 5% annually since 2014, against 2 to 3% in the US, the rupee's purchasing power steadily thinned, aligning with classical economic patterns where higher domestic inflation gradually depreciates a nation's currency. These domestic pressures were repeatedly amplified by global disruptions. The 2008 financial crisis had earlier sent the rupee from 43 to 50 per dollar, exposing its sensitivity to global capital flows. A similar pattern unfolded during the 2013 taper tantrum when fears of reduced Federal Reserve stimulus triggered outflows across emerging markets, nudging the rupee close to 68. By 2020, as the COVID-19 pandemic suppressed remittances and tourism, two major contributors to India's external earnings, the currency again slipped, this time beyond 75. And when the Russia-Ukraine conflict erupted in 2022, crude oil prices surged globally. With India relying on imports for over 85% of its crude needs, annual import bills soared above $150 billion, pushing the current account deficit to 2.5% of GDP. Each episode underscored how external shocks seamlessly transmitted into exchange rate volatility. India's domestic economic strategies during this period added their own complexities. The Make in India program, launched in 2014 to expand manufacturing's share to 25% of GDP by 2025, achieved limited traction. Despite liberalizing FDI caps in sectors such as defense and railways and simplifying regulatory pathways through single-window clearance systems, manufacturing remained stuck around 14 to 15% of GDP. Factors such as slow land acquisition processes, high borrowing costs for small firms averaging between 12 and 14%, and a banking system strained by non-performing assets that peaked at 11.5% in 2018 prevented sustained industrial expansion. These weaknesses restricted India's export competitiveness, thereby deepening its trade-related exposure to dollar demand. Even foreign direct investment trends reflected a maturing yet increasingly cautious investor climate. Although gross FDI inflows reached $81 billion in fiscal year 2025, a modest improvement over previous years, the country recorded net negative FDI of $353 million once large repatriations worth around $49 billion were accounted for. Major exits from high-profile IPOs involving firms like Hyundai Motor India and Swiggy contributed substantially to the reversal. Meanwhile, Indian conglomerates expanded their global portfolios, driving outward FDI to approximately $29 billion, further shifting the balance of capital flows. Supporters of the Modi administration frequently highlighted achievements in infrastructure and welfare delivery to counterbalance these economic stresses. Public capital expenditure rose to 3.3% of GDP by 2025, resulting in major upgrades. Tens of thousands of kilometers of new highways, near universal village electrification, and large-scale digitization of welfare transfers through more than 500 million bank accounts. These reforms indeed improved service delivery and reduced inefficiencies, but they did little to relieve the mounting pressure on the external sector or to reverse the rupee's structural decline. By mid-2025, international trade tensions surged dramatically. New US tariffs raised to 50% on various Indian products as retaliation for India's continued purchase of discounted Russian oil, slashed exports to America by around 20% in September alone, impacting nearly $48 billion worth of annual shipments. Labor-intensive sectors such as textiles and gems, which together contribute over $20 billion in exports, saw severe contractions, with independent assessments estimating 500,000 job losses. Meanwhile, cultural consumption patterns fueled unusual spikes in gold and silver imports. Gold imports jumped 200% to $14.7 billion in October, and silver surged over 530%, pushing the merchandise trade deficit to a record $41.7 billion for the month. Capital markets offered little relief. Foreign portfolio investors sold roughly $17 billion in Indian equities by November 2025, marking the largest annual exodus on record. Domestic firms reduced overseas borrowing to around $10 billion annually, while non-resident deposit inflows, traditionally an important buffer, showed a weakening pace. Importers, unsettled by the rupee's persistent slide, aggressively hedged their exposures, while exporters delayed dollar conversions in hopes of more favorable rates. This imbalance placed outsized pressure on the Reserve Bank of India. The RBI intervened steadily, selling over $26 billion between September and November alone, and maintaining forward positions short of more than $63 billion to absorb volatility. Despite the drawdown, foreign exchange reserves remained substantial at around $688 billion, covering nearly 11 months of imports, far exceeding the conventional benchmark of 3 months. This provided stability, but at the cost of narrowing future intervention capacity. Behind these macroeconomic shifts, the daily lives of ordinary Indians increasingly reflected the rupee's weakening trajectory. A simple grocery run in Delhi made evident the inflationary creep, a loaf of bread costing 35 rupees instead of the earlier 20, or fuel hovering around 110 rupees per litre, creating a tangible squeeze on household budgets. Commodities linked to global prices, cooking oil, pulses, and transport services, showed pronounced increases, especially for families already balancing tight incomes. Currency depreciation also affected small businesses reliant on imported components, raising costs for electronics, machinery, and medical supplies. Looking ahead, the rupee's direction hinges on a mix of geopolitical resets, monetary adjustments, and domestic resilience. A potential India-US tariff settlement could revive export momentum by as much as 10 to 15% and attract up to $20 billion in investment flows. Forecasted Federal Reserve rate cuts may ease emerging market outflows, while the RBI's expected reduction of the repo rate to 6.25% could support domestic growth, already estimated at 8.2% for the third quarter. Yet these prospects cannot obscure the broader lesson. India's currency challenges stem not only from global disruptions, but also from shortcomings in long-term economic strategy. The failure of major initiatives to expand manufacturing, strengthen export capacity, and reduce energy dependence has left the economy vulnerable. Until these structural gaps are addressed, the rupee will remain susceptible to the very pressures that brought it past the 90 mark. The woman bargaining for vegetables in Delhi may not follow currency charts, but she feels every shift in her daily expenses. Her experience, echoed across millions of households, captures the real weight of currency depreciation. As India moves into 2026, stability will depend not only on market movements or upcoming policy announcements, but on the nation's ability to rebuild the foundations that support a strong and resilient rupee.